Hello, and welcome back to our next wealth building strategies workshops called Avoiding Investing Pitfalls, Mistakes, and Problems, Part 1. At any time, if you want to connect with us, want to look at or evaluate investment opportunities, in the bottom right-hand corner, you can just text the word passive to 66866, and we'd love to talk to you a little bit more and give you an opportunity to review our investment selections for individual investors. I'm Eric Mattingly. I'm president and founder of DMI Holdings. My partner and co-owner of DMI is Leon Chasteen. We've been in business since 2008, and we provide passive investment opportunities for individual investors. We focus on strategic partnerships with quality operators, and from 2008 to present, we've been involved in a little over $1.5 billion in investment transactions, totaling a little over 100 private placement offerings. So today's topic is an important one because a lot of investors don't know what to look out for. And there's a lot of basic concepts and principles that we share with you in these workshops to help you become a more educated investor. One of the first mistakes is just lack of investment education. A lot of investors just simply do what I call haphazardly investing, and a good investment comes along and they just throw money at it where they really don't completely understand the investments that they're investing in. So if you don't understand it, it's not a good idea to invest, because if you can't understand how you can make money, you absolutely cannot understand how you can lose money. So it's important that you educate yourself, and workshops like these, online education and research and things like that. So I always tell people you're going to pay for your education one way or another. You can either do it the easy way or the hard way. So spend a little time, educate yourself. If you're going to invest out of your comfort zone, you really need to understand what investment options are available and some principles to follow when you're looking at investing, and where you should hold those investments based on tax treatment. And we're going to be covering a lot of those things today. You are responsible for your finances. A lot of investors just turn their money over to a money manager, and they expect that money manager to do a good job and grow their money. And predominantly, most of those investments are in volatile investments where you have no control whether the investment's going up or down. There are a lot of other investment options available to you out there. And so you want to be able to recognize a good investment opportunity and understand how to evaluate it so you can make an investment decision to truly diversify yourself out and have investments outside of the stock market. So I always ask people, would you rather have a bag of gold or a book of knowledge? Again, just turning your money over to somebody else without any real knowledge or understanding of how your money is going to grow is very, very risky. So learning what to do and having the knowledge yourself is going to help you as an investor make better investment decisions for yourself and your family. Just remember, your bag of gold can be stolen. Once you have the knowledge, it's yours. Nobody can take it away from you. And you can apply those things to investing. And you can also share those and pass those down to your kids and your family so they make wise decisions as well. Unfortunately, financial literacy is not taught in school. We deal with a lot of medical professionals, business owners that make a lot of money, but they just really had no training and education on investments. And so if you have those resources, you really want to make sure that you know what you're doing so you can grow those and develop income from other sources. If you haven't seen our multiple streams of income workshop, please watch that. Talks about a variety of different types of income producing investments that you can invest in. So one of the things that's important is just to know your financials. A lot of people don't review their financial statement. So your income statement is your income and your expenses, and understanding that taxes is the largest expense in life. So it's very important that you know the difference between W-2 taxation, business taxation, and real estate taxation. There's different places you can invest from. So based on the strategy or the investment you're doing, and based on the kind of returns that that investment generates, should dictate where you might consider holding those investments, not to mention your own personal investment goals and objectives. Your balance sheet is first your assets, all your assets that you have. I personally review my financial statement no less than every month. I'm always wanting to add to my assets and my income column so that no one investment, or if you lose your job or your business fails for whatever reason. A lot of businesses failed during COVID, and investors that had income from other sources were protected. So the definition of an asset is it puts money in your pocket. An asset feeds you. Your liabilities are any debts that you have, which would include, generally, your largest debt is your home mortgage, and credit cards, car payments, bank loans, boats, and other things like that. And a liability takes money out of your pocket and it eats you. A lot of people think that their home is an asset. Your home takes money out of your pocket. Even if your home is paid off free and clear, you don't have a mortgage anymore, but you still have property taxes, you still have insurance you have to pay, you have utilities. There are strategies to turn your home from a liability into an asset, but we'll cover that in a different workshop. So you want to buy assets that produce income. So things like real estate, dividend-paying stocks, flipping homes, things that generate capital gains. So income isn't just cash flow. You can invest in things that may not produce immediate cash flow, but produce capital gains. But if you just put your money in something and hold it until your retirement age, well, then that's not actually going to help you from an income standpoint. So whether it's cash flow investments or capital gain investments, those types of returns can help to pay for your lifestyle. So this is what I call the wealth strategy. Wealth is created by owning assets that produce income or gains to buy more assets that produce more income and or gains. So if you have assets that produce income, for example, let's use an apartment complex. You own part or all of an apartment complex. You have renters in there. They're paying rent to you. So you're a liability for them. That is an expense that they have. That generates income for you to allow you to turn around and go and buy more assets that produce more income. Once you have a number of assets that are producing income or capital gains, it doesn't take too long for you to really compound your cash flow situation by being able to do that. Let's talk about mutual funds. Uneducated investors will invest in mutual funds, or you're part of a 401k plan, and the only options they give you are a selection of mutual funds, bonds, a money market account. Unless you can self-direct your retirement plan, those are really the only options that you're giving. So let's just look at what a mutual fund is. And if you haven't seen the workshop, which is one of the first ones that we do, Investing Fundamentals, which really just teaches you the difference between an investment and speculation. So an investment means you're buying investments where you can protect your principal, you can create value. And so with a mutual fund, for example, it's simply just a packaged group of stocks. You can't control whether the stock market's going up or down. There's fund management fees. So whether your mutual fund is going up or down, the management company is charging fees. So you can actually compound your losses with the charging of fees in these stocks. Some of the stocks, when you buy them, are going to be up. Some may be down. Most people don't even look at or understand or know what the stocks are that are inside of their mutual fund. In addition to the fund management fees, if you have a money manager, your money manager is charging a percentage of money under management as a fee. So they charge those fees also, regardless of the performance of your investment. The fund manager and your money manager don't just make money when you make money. They make more money when your portfolio is up. They simply make less money when your portfolio is down. So there's a real conflict of interest there, and that really just dilutes your return significantly, and it's highly, highly speculative. Fees are charged regardless of profits and loss, and there's just no way to determine the price of each individual stock at the time you purchase that mutual fund. So let's talk a little bit about tax treatment. This is where taxes and investment losses are where you really can erode a lot of your investments. So there's different places that you can invest from. You can invest from taxable accounts, you can invest from tax deferred accounts, and you can invest in tax-free accounts. So just to give you an example, if you have a brokerage account that's in your name, that's a taxable account. You're going to be subject to whatever the tax laws are based on the buying and selling activity inside of your account. You have tax deferred accounts like IRAs, 401ks, SEPs, KIOs, and any type of retirement plan, healthcare savings accounts, etc. Tax deferred. Tax free would be an example would be a Roth IRA. So it's after tax money that goes in. However, you can invest that money, grow that money tax deferred, but the power of the Roth IRA or a 401k Roth is that when you start pulling that money out, it comes out to you tax free. You also have no required minimum distributions. Whenever you pass away, that Roth IRA goes to your family members tax free versus a traditional retirement plan. You have required minimum distributions at 70.5. And then when you pass away, that retirement plan goes to your heirs at their highest tax bracket. So if you haven't seen Real Estate in Your Retirement, Self-Directed IRA Investing 101 and 201, please watch that. And we go into way more detail specifically on retirement plans. There's different types of income and they're all taxed differently. One of the workshops that we do really kind of goes over that in detail, but we'll just cover high level here. So your earned income is just based on how much money that you earn. The more you make, the higher your taxes are on just about everything that has tax to it. Passive income is taxed at a flat rate, plus you get depreciation deduction. So it's one of the important reasons to invest in real estate. A real estate investment trust is not investing in real estate. You don't get any of the tax benefits. So you might have a real estate investment trust and it's tax advantage income that goes in. There's depreciation deductions that are given. But when that income is sent to you, it's sent to you in the form of a dividend, which is taxed at your earned income tax rate. A lot of people don't understand that. So direct participation in real estate investments also provides you tax advantages. So if you're going to, say, invest in a rental property or a multifamily property, and you invest in that property outside of your retirement plan, which you can do inside of a self-directed IRA, you're getting substantial tax benefits from investing in a taxable account because it's a tax advantage type investment. Dividend income comes to you in your earned income tax rate. It also could increase your earned income tax bracket. So you may not only pay tax on that at your earned income tax rate, you may also bump yourself up into a higher tax bracket. Same thing with short-term capital gains. Residual income, let's say you have a network marketing company and you're building up your downline. Initially, your income is active. Then once you have a substantial downline and your income grows from efforts other than your own work, then it's passive. And royalty income is passive. Interest income, lending is a great investment strategy. We have a workshop called Asset-Based Lending. If you haven't watched that, please do. But we talk about this. It's a very unique investment. It's one of the few investments where you can create your own discount, and you can also charge high interest rates. If you're working with a skilled real estate investor, they're going to need private investors or private lenders, whether that's a hard money lending company, or you can do your own hard money loans secured in a first lien position against the property. It's a very safe investment, but it does generate interest income. And so this is an investment you may want to consider doing inside of a tax deferred or tax free account so that you can keep all of that interest. So if you're charging 12%, 14%, or you have a 2% origination fee and a 12% interest rate, that is a substantial fixed return secured by a hard asset that if it goes non-performing, you can foreclose, take the property back, sell it, get your money back, and potentially more than you would have been paid in interest. And if that's inside of a retirement plan, you keep all of that tax either deferred or free, depending upon what kind of retirement plan you're using to do the investment. Short-term capital gains, people that flip stocks, trade stocks, people that flip homes, that is taxed at your earned income tax rate. It can also bump you up into another tax bracket. So if you're going to trade stocks and flip stocks and you want to keep your taxes as low as possible and keep a good majority, if not all of the return, then you're going to want to do those kinds of investments inside of a traditional or a Roth retirement plan that you can do that self-directed. Long-term gains, it's just based on your earnings, is going to dictate how much tax you pay. Not going to go over that in this workshop, but we have that information in previous workshops. But anytime you can hold that investment for 365 days or more, if you're fixing and flipping a home and you're at month 11, you want to set your closing date to close after, on your 356th day or whatever, the day after 12 months, so that it's long-term capital gain versus short-term capital gain if you're doing it outside of a retirement plan. If it's inside of a retirement plan, you want that return as fast as possible so you can turn around, reinvest it again, and compound your money that way. You can take loans out against your life insurance policy, still earn money in the life insurance policy. We have a workshop called Be Your Own Banker, Tax-Free Retirement. We haven't recorded that one just yet, but we will. And there's some incredible strategies you can use. But when you borrow, you don't withdraw money out of a life insurance policy. And this is a cash value life insurance policy. You borrow money out. So the money that the cash value still continues to earn returns. You do owe an interest back to your life insurance policy. But for example, if you know how to do hard money loans and you can generate 12 to 14% on your money, you might have to pay the life insurance policy 6% interest to pay back that loan. But you can generate additional income with an asset that continues to produce income that you own. So some really interesting strategies you can do. We'll cover in a different workshop. And then you can also refinance properties. Refinancing a property is a loan. Loan proceeds are not taxable, tax-free at the time you receive the loan. So it's a great way to build wealth. And there's some strategies. We have another workshop that has to do with 1031 exchanges done by Dugan Kelly with Kelly Clark. And so there's some information there if you're not familiar with the 1031 exchange, and you can continue to defer those taxes indefinitely without winding up losing a good party return to taxes. Next section is just not owning tangible assets. So there's some real benefits to owning real estate. There's a lot of different types of real estate. We're not going to go into all of those options here today, but owning real estate and investing in real estate is definitely an important part of your investment strategy. Not having real estate in your portfolio is a mistake, in my opinion, that a lot of people make just because a lot of times they don't really know how to do it. It takes a lot of time, effort, energy, money, and training to learn how to be a skilled real estate investor. No different than it takes time, effort, energy, and money to learn how to be a skilled professional stock market investor. So what a lot of passive investors do is they will look for a professional real estate investor that has a track record, and they want to just be an equity partner and invest on a passive basis to allow them the benefits of investing in real estate without having to identify the opportunities and then manage and oversee it, that does have to be done. So if it's a single family home, for example, you would just hire a property management company. If you were going to do a single family rental, those are pretty easy to do. But if you're going to work with somebody who fix and flips homes and you want a little bit more of an upside, you're going to need to find an active investor to work with. But some of the benefits are it can provide positive cash on cash returns. That means that like a rental property will distribute cash flow to you. This will help you with having those multiple streams of income. Each property or investment you do is an additional source of income. There's also capital events that occur. It's a hedge against inflation. You look what happened over the last couple of years, how much inflation has gone up. Everything costs more, but not everybody's income went up to match those expenses. Just going out to dinner and meals and entertainment, all of those things are more expensive. So it's really kind of put a crunch on a lot of people. There's also flow through tax benefits that you get. So depending upon the kind of properties you do with real estate, you can get cost segregation and bonus depreciation deductions that can equal anywhere from 50 to 100%, sometimes more, of the original invested amount that you can take in year one. If you're an active investor, and if you're a passive investor, you can spread those deductions out over the life of the investment. And then each year you continue to get depreciation deductions that flow through to you. So that passive income that's being generated, in most cases, you may not pay any tax on that because of those tax deductions that you get along the way. That's a huge benefit. So compare that to the earned income, and it can be up as high as 35%. If you can zero out your taxes, then you will be able to use all of that money for funding your lifestyle. Investment is secured by a tangible asset. I like to be able to see, touch, and feel investments that I do. And so real estate's a hard asset, and it's a great way to build wealth. It can produce income and cash flow and a gain on equity. So when you sell, you can make a substantial capital gain. If it's long-term, it's taxed at the lowest rate, but if it's inside of a retirement plan, you keep all of that money without having to pay tax, so you can reinvest that money and compound your wealth. There's also capital events. So let's just use a multifamily property, for example. After about 2 or 3 years and you increase the income and you reduce the expenses, you can generally go in and refinance that property and have a loan proceed distribution that would go back to investors. So you could ultimately, after 1 or 2 refinance events, have 100% of your money back out, not pay taxes on those distributions because it's treated as a return of capital up to the point you get all of your capital back, still continue to get income, still benefit from a gain on sale when you sell, and you can hold that investment long term. You can do that inside of a retirement plan. There's not a lot of investments out there that within roughly 5 years, you could potentially get 100% of your money out and still own the investment and be able to reutilize that money to go invest in other things. It is a powerful, powerful tool. Strongly recommend that as an investor, you own real estate in your portfolio. So why real estate? You have the ability to leverage. So you can benefit from a larger return on the total asset with a smaller investment. So just a quick example on the chart below, and on the left, you see a real estate investment. On the right, you see a mutual fund investment. So first and foremost, that mutual fund might go up and or down. But if you invest $20,000 into a mutual fund, the value is $20,000 unless it goes down. If you got a 15% return, which is very, very difficult to do on a consistent basis. In fact, the stock market does not produce a consistent 15% return per year, even if you sat in the stock market for 15, 20, or 30 years. But that would mean that you would make a gain of $3,000. If you look at the example on the left, you put $20,000 as a down payment, you get financing for the balance on a $180,000 property. And let's say you only generate a 5% return. If you look at the appreciation rate of homes over the last several years, they're just crazy. But in normal circumstances, 3 to 5% is pretty normal. And so with a $20,000 investment, same $20,000 investment, you're getting the benefit of the equity appreciation on $180,000. You're leveraging your return. So you would make $9,000 with a 5% return versus $3,000 with a 15% return. So again, it is a powerful wealth building strategy tool. And with that, I hope the information I shared with you was beneficial. I will be back with you for Investing Pitfalls, Mistakes, and Problems, Part 2. We'd love to have an opportunity to talk to you. So again, if you'd like to reach out, have an opportunity to look at passive investments that will help you to achieve your financial goals, you can text the word passive to 66866, or you can reach us by phone. Our main line is at the bottom, 972-239-5766. Also, please check us out on the web at investwithdmi.com, or you can email us at invest@dmi-mgt.com. Thank you for joining me today, and I look forward to seeing you again.